Welcome back to the Behind the Well Show. I'm your host, Roger Abel. Elias Randall next to me today. Elias, we're halfway through summer. How's it treating you?
Hot.
Kind of like the markets.
Yeah, there you go.
Markets have been hot.
Yep, market's hot. Summer's hot.
Just got
Is the market going to stay hot?
Maybe. According to Ryan Dietrich, there's some good information out there.
Yeah, I think there's more and more people getting on the kind of the bull market will continue train.
Yeah, I don't want to tease it, but we actually have information about this in the next podcast we're going to be doing. Some of the information that Ryan, there's the tease right there.
The teaser.
Ryan Dietrich with Carson Wealth, formerly with LPL, has a statistic. S&P just did something it's only done 4 times in the last 50 years. And honestly, it's pretty positive for the market. So if you want to get that, tune into the next episode, and you'll be able to get the information on that. But it's pretty cool. One of the things that I think is fun about summer is just all the free time that you have with your family, friends, kids. But one of the things that I've noticed my kids are gravitated to, and I know yours are too, because you spent time at the lake house with me. They really like to make videos and post videos.
Yeah, my daughter's, she told me she's YouTube famous now because they had a video go viral.
With 1,800 views.
Yeah.
Yeah, that's viral to a 9-year-old or 10-year-old, that's viral.
Yeah, and she was getting on her iPad twice a day to see how many videos, how many views the video had, and then I get subscriber updates too.
Did you get her a channel too?
We're going to.
Yeah, Molly did, aren't you?
Probably.
Molly doesn't know this, but I have another friend who's can't figure out why their kid can't post videos, kind of like we did. And I said, well, you need a Molly to fix that problem.
Yeah, I think it's a good idea. And my daughter does all these activities, so I told her, if you just, you don't have to do just the dances and stuff, but like she plays violin, piano, plays a couple sports. So like video yourself shooting hoops in the driveway and just post it. Video yourself when you're practicing your violin and post it. Like if she's 10, if she posts videos consistently until she's 25, I would imagine she'll have some kind of following.
So Blake goes, Dad, how do you guys have X amount of followers? I said, because we've been doing it 5 years.
Yeah.
Like we've done it for 5 years. It's time. We had that talk. The longer they have the channel, likely they're going to have more followers. But what's interesting, Elias, is that the video that Blake and Nelly posted wasn't the best video they made. The best video was with us doing chicken banana with them.
That one should have went viral, but it didn't.
Molly could probably find chicken banana and put it on the YouTube channel for everybody to see. But our kids got us together and did chicken banana because all day on the boat, all they wanted us to play was chicken banana.
How did that start?
I have no idea. Probably some influencer.
Yeah.
But, there's the thing with social media. There's good information, bad information, entertaining information. But I get caught up in reels. I think you probably get caught up in them too, just especially on Facebook. Like I'll click on something I want to look at, and the next thing I know, I'm like 15 deep in stories of different random stuff. And it happens to me on YouTube too. I'll click on one thing.
Yeah.
And somehow I keep clicking on all this like really good looking street food from other countries. And I can't understand a word that they're saying. Like they're making something like, man, that looks good. And then it's to the next one and the next one and the next one. I'm like, I don't know what they're saying, but it all looks good. But there was one that caught my eye the other day. And there's all of these financial hacks on TikTok. Some are good, some are bad. But this hack I want to review and talk about today, it's called the TikTok hack to help your child retire with $4 million. Have you ever seen this one?
I have not seen the TikTok. I read the article about it, so I know the concept.
Okay. So it's Freddie Smith. I'm going to give credit where credit's due. Published this viral TikTok clip. It's a guy's name. And it was a thought experiment. And really, it was the promise that if, a college graduate or a young person were to just sacrifice 3 years of their life early on, they would be able to retire with $3 to $4 million. And I'll set up the scene so everybody kind of understands what we're talking about. But his first suggestion, which is like the biggest no-no of all, but whatever, is that you co-sign the purchase of a car that will enable your 16-year-old to earn $1,200 a month on the side. So for all of this to work, your child who's 16 has to earn $1,200
a month.
A month. But I mean, so let's break that down at minimum at $15 an hour. They got to work what? Like 80 hours a month? It's like 20 hours a week. That's actually a lot for a student to work. Where are they going to get 20 hours a week?
Dude, I don't know.
I mean, think about it.
Coffee shop.
So this is where I caution people on, financial advice on TikTok. In theory, this is great. But your high school student who gets home at 3 o'clock or 3:30, apparently they're in no activities, or they work all weekend long to make enough money to even start this thing out working. And the whole premise is they're going to make $1,200 and take $500 to pay off the car. Okay. And the goal is to have a fully paid for car by 18. Well, if this individual could make $1,200 a month, couldn't they just wait for 5 months and have a fully paid for $6,000 car?
Yes. And I don't know where these folks live, but anyone ever heard of a bicycle?
How about here's what, no,
Ride
hold on.
your
It's going to
bicycle.
get better. It's going to get better. Okay. Then after 18, they get a $35,000 a year job. They get to spend $10,000. So $10,000 to play with, which isn't very much. And they put $25,000 into the stock market for 3 years. So at 21, they put $75,000 in. Assumed a 10% annual return would make the account worth $4 to $5 million in their 60s. Okay. So we're going to go into like some of the assumptions and how this actually works, because some of these assumptions are just wild. But the first assumption is that from 18 to 21, the parents are subsidizing the kid's lifestyle. They are letting them live at home. They're paying for the stuff. They're literally subsidizing their lifestyle.
Okay.
Doing everything for them. So let's roll back to this co-signing of a car, which is a bad idea. If they were going to subsidize their kid's lifestyle, why didn't they just buy them a car?
See, that's when.
Why did they just
I'm
drive
with
them
you.
to work?
Yeah, I'm with you. So I think here's where I'm at with this. I don't know if this is the way I would execute this type of idea. I think conceptually I do agree with some of the thoughts. I mean, most parents are subsidizing their kids' life, certainly until they graduate high school. But it's pretty common now that even college kids are still living on mom and dad's bill for quite some time. But I guess I'll take this even, and I can take this even further. So, and I will be someone that I am going to help my kids get a leg up financially, but like that's my prerogative. I can choose to do that. I'm not going to be irresponsible about it. They're not going to be spoiled. They're going to earn it. But I could even add to this. Because one thing, and I think we've talked about this before, just think about, okay, do you have kids playing club sports and all this craziness that people do now? Well, for the money you spend on that, It doesn't change two things. One, it doesn't change the number of kids that are the percentage of kids that will get a scholarship to play in college for free. And it does not change the percentage of people that will be a professional. It doesn't matter how much you play at that age. Well, I think about my family. What if we took all the money we spend to participate in athletics and go to a tournament on the weekend, and we saved it for college? They'd probably go to any college you ever wanted.
They will be able to. Think about this. The likely outcome for a child today playing a sport, 9, 10, 11 years old, the likely outcome is maybe they'll play in high school.
Yeah.
And if they play in high school, by the time they're done, they will likely be done, whether they were good or not. There's a lot of great athletes who are all-state athletes that don't go on to play college sports.
Oh yeah, there's a lot of them. So
yeah,
just,
and a lot of that's
this,
choice.
So this idea that, yes, I do believe people should help their kids with money, educating them with money. But like some of the examples where it says, and then you live at home from 18 to 21 and you get a job making 35,000, like that's pretty generic. But if someone, let's say I knew a young person, they said, I'm going to join the local union that takes care of the power lines in my area, and I'm going to do an apprenticeship. I'm doing the apprenticeship. I'm going to live at home so I can save up money to buy a house and get my retirement started. And if mom and dad are happy to have you, that's a great way to get yourself set up for future success. But this just says get a job making $35,000 a year. Well, there's plenty of jobs you don't need college education where you can make much more than $35,000 a year. So I think this is like, yeah, this is getting you kind of on the right path, but
I think
I don't know that it would just work exactly the way this is lined out.
So I want to hit a couple other of the assumptions in here, which I think are inaccurate. And then we can talk about what I really think this is telling people and put it into a real life example of how to be successful financially, teach your kids about it. So the first assumption was mom and dad are going to subsidize their life, which I don't know too many parents who are like, yeah, let me pay for everything while you save money. Like that's just taking money out of one pocket and putting in the next, right? Mom and dad could have just given them the money and invested it for them, which is much more likely to happen. 2, very few people that are making $35,000 are going to be willing to save $25,000 a year and live on $833 a month when they're 18 to 21 years old.
Yeah,
they get $200 a week. Their cell phones, well, once again, mom and dad, we're supposed to subsidize everything. But these high school kids today, and I'm not being disparaging, they spend $35 at Chick-fil-A. And they buy a Starbucks. They're spending $200 a week on food, guaranteed.
Yeah.
And mom and dad aren't going to subsidize that. So I think the savings rate is not realistic. But here's what I really don't think is realistic. A 10% annual return every single year with no variance.
Yeah, there's no variance applied to that. Yeah, so that's absolutely unrealistic number then.
Yeah, what I tell people, if you're going to use a static number or a linear return where it is the same every single year, 7 or 8%, because you have to have a way to account for the variance. If you were to drop the rate of return from 10% to 8%, it actually takes the total account down to just a little over $2 million.
Which in my mind, without really running any serious calculation, that's more reasonable to expect.
And if
Don't
they
you
earn,
think?
Yeah, and if they earn 6%, it's $1 million.
Yeah. So you're gonna have anywhere between 1 and
4 million.
2. Yeah.
Right. So let's talk about what I think this is really trying to portray to people. And it's something that we have tried to talk with young people about literally from the day I started doing this. And we used to have a chart when I started in the business 22 years ago, Elias. Well, I guess 23 now. And it compared investor A to investor B. And investor A started investing money at 21 and investor B started at 31. Investor A only invested for 10 years. At 65, investor A still had more money than investor B. All this is telling people, get money into the market sooner rather than later. It's showing this is just the power of compound growth. We've talked about in previous episodes that, if you put $5 million into the stock market, let it sit there for 50 years, it turns into $1 million. So
pretty minimal investment.
Minimal investment to do it.
And minimal work after you own the asset.
Okay, are you ready for a real crazy one?
Yeah.
And this is, so I was Barry Rhold's Wealth Management. I was watching an interview with him the other day, and this is wild. And he was talking about how people think cash is safe. And really, cash is safe in the short term, but at the long term, there's a lot of risk associated with it. And this is the analogy he put, and this is true fact. He said, let's assume we had two people that went away to World War I. They each put $1,000. One person invested $1,000 in the stock market. The other took $1,000 and buried it in the backyard. Okay. Over the last 100 years, investor that buried the money lost 96% of the purchasing power. So it's worth $4 today because they held cash. That is safe investment in cash because 1,000 is still 1,000. Do you know what the stock market investment was?
I don't, but
Throw a crazy number out there.
$1,000 for 100 years.
Well, since the beginning of World War I. It's going to blow your mind, dude. You won't even be close.
I don't know. 5 million?
30.
Holy crap.
You start to think about that. Like, it doesn't take a lot of money to set your kids up.
And
It's just
so that's 1,000 over 100 years?
100 and some change.
100 and some change. Yeah. Wow.
30 million. But that's how wealthy families set each other up. They don't tell their kids to go, they don't co-sign a loan for a car so they can earn a fictitious $1,200 because that's not going to work.
Right. And so along with that, Barry Rhold saying that. So that's funny you mentioned because I just saw a reel of Warren Buffett talking about the difference between owning stocks and owning bonds. And he does make the point that some people just psychologically and emotionally cannot own stocks. Fluctuates too much. But he said, if you think about it, the longer you hold a bond, the more risky the bond comes. Or the longer you hold good stock market investments, the less risky they become over time. And I'm assuming he's hinting towards opportunity cost and the ability to grow your wealth exponentially. So then I started thinking about it. I said, yeah, if you were to buy like a 30-year bond, $1,000, or you were to put $1,000 into the S&P 500, you would feel safe today and the whole time you own that bond, but you would drastically underperform what you could accomplish.
Do people understand that bonds and cash are designed to basically keep up with inflation or slightly below it? Like, what do they do?
I think most people.
I kind of wonder, if you think about what the Federal Reserve does, we set interest rate policy, which is what drives bond rates and yields. Yeah, you get a little bit more interest rate typically on longer duration bonds, but it's not really enough to make up for the opportunity cost of being in the equity market.
Not over a 30-year period.
And it holds a risk because if interest rates go up, now you're locked into a 30-year bond. There's a lot more risk than people think with bonds. They don't see it on their statement, but it's really the purchasing power risk.
Yeah, and they don't see it. Two, they don't feel it. Like in the spring when we had all the tariff chaos and the markets super volatile, like, okay, you look at your bond positions and which one makes you feel better at that time? So I think if people just really understood fundamentally how stocks are priced and some of the more mechanics behind it, because I think people think stocks, like they just think a stock has a price and that price goes up and down. They couldn't even tell you, well, what makes that price go up and down? Like they don't even know, they don't know it's supply and demand, right? In a publicly traded market. But fundamentally, the price of a stock is driven by how much money the company can make, right?
That's
so
it.
is it always rational? No, because the market's open 5 business days a week, has trading hours, and it's publicly traded. So the price always right? If it wasn't publicly traded, like if there was just a way to, this is what this is worth today, and you just always bought at a fair price, that'd be one thing, but that's not how we do it.
Yeah, I think that's a good point. Like very rarely are stocks perfectly priced. They're either priced at a premium or a discount.
And the best companies are priced at a premium.
At a premium, but then how do you determine what's the fair premium? You benchmark it against the other companies similar to that.
Yeah.
Here's what it goes to. This is the only industry in the world that people think they can do this themselves and be better at it than having a professional in their corner. And I think part of it is because companies like Vanguard and low-cost providers have went out there and said, hey, fees are the only thing that matter. But here's what's super ironic. Vanguard just posted their latest survey of investors. It talks about the value of advice. And they did this survey like several years ago, but highlighted a couple key points that advisors add and how we add alpha. And I think, there's this misnomer that an advisor is going to go pick better investments. They may, right? But that's not really adds the alpha to the portfolio or the excess return. Vanguard came out and said advisors, it's really an emotional payoff. We're helping clients with emotions, but also with time. All right. 3/4 of the clients say financial advice saves them a median of 2 hours per week. And 2 hours seems like a lot, right? Because someone at home saying, hey, I'm not thinking about this 2 hours a week. I'm not spending 2 hours a week in my 401k. Yeah, you might be, because you might be doom scrolling and thinking about what you have to do and all these other things that are in the back of your mind about your finances when you could be out doing all of this other stuff. Okay. On average, Vanguard estimates that investors spend 3.8 hours a week distracted by financial stress while at work.
That seems like a lot.
Well, not really. It's like 40 minutes a day. Think about it. It's not 40 minutes. Like you're thinking about it in a 3.8 hour block of time.
Yeah, it's 2 minutes here.
Yeah, it's 8 minutes.
2 minutes there.
It's like 8 minutes an hour. And 8 minutes an hour, someone's thinking about it because they're on their phone. Oh, man, did you see what XYZ stock just did? What's going to happen with this tariff? Oh my gosh, we're going to fire Jerome Powell. All of that stuff goes into it.
Yeah.
So the economic benefit to a client estimated by Vanguard, this isn't us, this is Vanguard, the low cost provider, right? That's how they built their business. By reducing stress, increasing peace of mind, on average, the annual cost per worker is between $5,950 and $6,775 in lost productivity.
Okay.
Think about that.
That's
like,
a lot. Yeah.
that adds up to a lot. And then, someone so just to put that into numerical value for someone who has a portfolio, if you have a portfolio of less than $600,000 and you're paying a 1% fee, just to take the angst away, you should be working with somebody.
I think for a lot of people, that's good enough.
I mean, people just undervalue. I mean, truth be told, if someone had $250,000 and they didn't delegate this, they're actually spending more money in lost productivity and time and all the other stuff that goes into it. That doesn't include, like, Elias, in this, that doesn't include investor mistakes, misexecuted a rollover. I tried to time the market. I tried to get in and out. That is just lost productivity. Vanguard published one about 3 years ago that said the value of an advisor is 3 to 4% a year. 3 to 4% a year. You know what most advisors charge? Around 1%.
Yeah.
It's
at 1 to 1.5.
Yeah, incrementally. You have more money, it's less. It's just like pop, right? But it's not incrementally more. So most advisors are pricing their services at a discount.
So I want to touch on something when you said just investor mistakes, and also when you were talking through that, you also brought up like the time. Okay, I'm sure there are people getting caught, and I like that term, doom scrolling. Which
That's what it is.
Think about all the people, like you have all these perma bears all the time telling you all the reasons why the market's going to go down and it's going to go down X. One, they don't know that. And two, and I think this is kind of timely because the new guide that we made is it called How to Invest When the Market's High?
At all-time highs.
Yeah, how to invest when the market's at all-time highs, right? And so one thing we've been talking with people about is, remember your story about seeing what you don't notice, or like finding.
That's what we're hired to do.
Right. So our clients are getting coached on how to invest when the market's at all-time highs. If you're just doom scrolling on your phone and managing your 401k, you might implement a like pseudo recommendation from a social media influencer that they're just trying to get clicks and get follows and get subscribers. And, is this market signaling that it's overpriced? I actually don't believe that. At this time, I do think there's enough conviction that the bull market will continue. I think our market is signaling growth. Now, are we still in some sort of economic lull and stuff? Is there a lot of uncertainty? If Trump fired Jerome Powell, would there be a negative reaction? Yeah, there's always stuff that can get a negative reaction, but even this earnings season, all these earnings, a lot of companies revised their earnings up during this last earnings season. So why don't you don't want to participate with them making more money?
It's interesting you bring up the Jerome Powell thing, because at this point, don't you think the market's kind of priced some of that in probably? Like, and for the market, I'm not sure it's going to be seen as a bad thing. Like, I think worldwide, they would potentially see that as a bad thing. But for the market, easy monetary policy, because it's easy monetary policy, likely leads to more growth. We talked about, before this past presidential election and before every election, we talk about the same thing. The president, who the president is, doesn't really determine the outcome of the stock market. Monetary policy likely determines the outcome of what the stock market's going to do. If we have easy monetary policy, stock market does well. If we have tightening monetary policy, which we saw in 2022, it didn't matter if it was a Republican or a Democrat. If you raise interest rates from 0 to 5, the economy's not going to do well. The stock market will not do well.
And at this time, what is the case to raise interest rates?
There should be none.
The Federal Reserve, they're talking about holding, so there's no case to raise rates.
Well, I could make the argument that we should have already cut rates. Because but I'm not asking. Right. Let me tell you why.
Who out there is making a call for higher? Like, no one.
I think there's people on Federal Reserve that think we're going to get tariff inflation. But here's all I'm going to say. Right. People that think the Federal Reserve knows what's going to happen, they're drastically wrong. The Federal Reserve looks at backdated data. They tell us they're data dependent. Well, now they're predicting. Well, guess what? In 2020 and 2021, all I'm going to say is transitory. And if people don't know what that means, for a year and a half, they said, inflation is going to be transitory. Guess what inflation wasn't?
Yeah, it was
transitory, which doesn't mean it's the same thing. We think we're going to have inflation because of tariffs. Well, the last time you thought, they were wrong.
So that was the point.
They were wrong.
That was the point I was getting at is there's no one making an argument that we're going to need to raise rates. Federal Reserve says they're data dependent. And if
Except for now,
inflation
because we
starts,
think
if inflation starts to tick up, couldn't you increase the overnight lending rate? If you're using the data to make
you would
decisions. Right, but now we're kind of stuck in this holding pattern, and it seems very, very speculative.
there you go. And there's actually signs of a slowing labor market. Like there's
Unemployment.
slowing. That's slowing.
And people are working less hours too. People are making less money in general.
Yeah. So all of a sudden, like inflation has come down drastically. Is it their 2% target? No, but that 2% target's an arbitrary target.
Right.
That's an arbitrary number that was made up.
Right. And you continue, like, how long do you continue to prioritize inflation over growth of the economy?
Well, I can promise you, if people out of work,
It'll change pretty quick. I would
yeah.
think.
Well,
Yeah.
let me ask, would you rather have 2.8% inflation and a job, or 2% inflation and no job?
Inflation doesn't matter if you don't
Inflation
have any
doesn't
money.
matter if you don't have any money.
Right.
And here's what gets me. People think prices are coming down. Prices are not coming down on goods. That's deflation. And even if we had deflation, it's not going to be meaningful.
No.
What's the largest year?
Deflation's terrible for an economy.
It's horrible. 1930 to 1933 was the largest deflationary period of time. Prices came down 25%. So let's put this in perspective. Your $3 eggs are going to go to $2.25. They're going to go to $2.25. I mean, that's like the worst case scenario likely is we have a depression, which nothing points to that. All these people waiting for prices to come down, they're not coming down. And why would you want it to?
You really shouldn't. The economy needs a basic amount of inflation to continue growing. Yeah, deflation. It's
And that was over a 3-year period of time. By
you
the
don't
way.
you don't want an economy where people are waiting to buy things because they think the price is going to go down. Like if you truly have deflation, and then people think, "Oh, I'm not going to buy a car because we're in deflation." It's going to keep going down. That would grind everything to a halt. You do not want that.
And I will tell you, home prices are coming down in parts of America. I know that.
Yeah.
I mean, but that's not necessarily deflationary. Like prices are coming down from all-time highs or all-time listing prices. I just saw in June, the average sale price hit all-time high in June.
And people we were in an environment where you could get away with that. Like when you can get a 30-year mortgage at 3%, you can afford significantly more home than you can at a 30-year mortgage at 6.5%. So it was could we end up in a situation like that again? We could, but that's not really the norm.
Yeah, Elias, people just need to make sure their expectations are in line. And honestly, it's why we have clients, because we help level set expectations for people. And you mentioned something just like a few minutes ago that we just released this new guide on how to invest when the market's at all-time highs, because it's really hard mental shift for people. People have been told since day one, buy low and sell high. So when you tell someone to buy low, they believe that is less than where they bought before. Low is a relative term to time. It could be buying at a higher price. And this guide we just released actually shows how buying at all-time highs versus trying to buy the dips yields better results. So I encourage our listeners, or if you're watching this on YouTube, hit the link in the description. We'll have our downloadable guide to investing in all-time market highs. Also, if you want like a nice copy, those are in print right now. We'd be happy to send you one. You can stop by the office and get one. But I encourage people to get that, because there's a lot of good information that can put you in a good mental headspace and view market all-time highs as a feature of the stock market and not a flaw. And I think it's viewed as a flaw. Hey, we're at all-time highs. Is now a good time to invest? If you can hold for 5, 10, 20 years? The answer is yes. And all you have to do is ask yourself today, if I had the opportunity to go back to 2005 and invest in the stock market, how much money would I invest? And the answer would be everything I can get my hands on. And it'll likely be the same thing in the next 20 years. So with that said, I want to thank everybody for listening. Hope you enjoyed the show today. If you're looking to reach out and delegate this part of your life, you can go to vtwealthshow.com, click the link in the description, or give us a call at 800-383-6590. You have any closing remarks for today?
No.
No, just a simple no? All right.
No. Thanks for listening.
The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets.